we interface with financial institutions all over planet Earth. We were early and aggressive. I mentioned we just started experimenting in blockchain. We began to understand that maybe there's a number of different blockchains that are going to be winners here. Blockchains are technologies. They'll continue to iterate. In the information-based economy, we think of these as just utility rails. So we want to be on as many of those ecosystems as we can, because that's where we're going to find customers eventually.
This episode is brought to you by Trezor. Trezor makes beautifully crafted hardware wallets that allow you to easily and safely store your crypto assets. Trezor's been in the game for a very long time. Since 2013, they were the pioneers of hardware wallets and the seed phrase setup, and their hardware wallets are open source. In fact, my favorite is the Trezor Safe 5. It's a beautifully designed and easy to use hardware wallet, guys, and it's my go-to. And they support a variety of coins, all your top crypto tokens, your Bitcoins, your XRP, Ethereum, Solana, and much more. And even new coins, even BlackRock's BUIDL token. So they support coins on the institutional side where you have tokenization of different assets and much more. And they even offer a great service that helps you to get your Trezor device set up. You get one-on-one customer support from their team, so you can check that out as well. So once again, I'm a big fan of this hardware wallet. So if you'd like to learn more, visit the link in the description.
Hey everyone, welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and we're recording at Station 3 in New York's Financial District. And joining me today is Roger Bayston, who is the head of digital assets at Franklin Templeton, which is one of the largest investment firms in the world, managing over $1.6 trillion in assets. Roger, great to have you.
Yeah, thanks for having me.
Roger, I'm excited for this conversation. Franklin Templeton is leading the charge in many different ways as it relates to digital assets. So I have lots of questions for you.
Awesome.
But I'd love to start with your background. Tell us a bit about yourself. Where are you from? Where'd you grow up? And how'd you end up at Franklin Templeton?
Wow. Well, I actually grew up in the Midwest, Central Illinois, but I came kind of the East Coast to do my undergraduate work at the University of Virginia. I came to Wall Street in New York in the mid-'80s, spent about 3 years here, and I found myself heading to the West Coast to go to graduate business school at UCLA. Once I got to UCLA and the wonderful Californian sunshine, I was like, well, this is going to be a good place to be. Ended up being hired out of business school at what then was known as Franklin Group of Funds.
Wow.
In 1991. And I've actually been at Franklin, and then, as we've been a net acquirer of asset managers over time, Franklin Templeton, since 1991. Who do you have on your show who's been at the same firm that long?
Nobody. That's an incredible tenure. So did you want to go into finance? Was that your target goal?
So I had some exposure when I was younger because my father was one of the first persons who took the CFA exam. And that CFA exam program is there's an organization, CFA, but there's a lot of professionals that aid in like creating the exam and grading the exam, and they really draw on the whole community of CFA participants in order to be able to make that whole thing work and hum. And this was many years ago now, but a lot of those CFA people had investment. They were investment people, right, in the investment community, and so I had a lot of exposure to a lot of different investment professionals, having been around that CFA institute early in my, when I was, in junior high and high school and those, college formative years. And so I had a pretty good idea that I wanted to be doing investment related things. And so when I I came to New York, I actually was working for a company that was then called Bankers Trust Company. And we were, in several locations in the city, but I was in the index fund group. So think about the period of 1986 toward 1989, which is when I was there. Explosive activity in the number of pension funds who were thinking about, hey, maybe I can, put some lower cost index fund passive investment strategies in our portfolio at a lower cost rather than paying high cost active management fees. So that's kind of where I cut my teeth. And it's been a great career. I've seen a lot of things over almost 4 decades of experience now in these markets.
Oh yeah, I'm sure you have a plethora of knowledge. And I'm curious what your point of view is, or perspective, I should say, on how the markets have changed, especially as they become digitized and with the internet and now blockchain.
Well, I think in the big thematic one is the fact that all of these technologies have continued to drive down the pricing of asset management services. I think of the world in two camps: those who have capital, and then those who want capital. So have capital would be like big major retirement plans, pension plans, and that kind of stuff. Those who want capital, businesses, who want that. And anything else in between, in the intermediary role in between, that take out rents between those two, that prevent the have capital for getting the most return on their capital, and the want capital to get the lowest cost of capital. Inside of all that are a number of different actors. And what we've seen is keep hollowing out of those actors and those rents in between. And I think, where we've arrived now with blockchain technology, because a lot of those rents in between those two actors are really a legacy of like, we have this record, you have that record. It's going to take us 5 days to settle a stock. I mean, that's when I first started, right? Because we have to get these records moved back and forth. And this whole distributed ledger technology where you have a record, I have a record, and it's the same record, really dramatically changes all of that. So I've seen that whole path, keep shrinking down. And I think that's ultimately to the benefit, again, of the owners of capital to get higher returns on capital. I think there's a whole bunch of other things happening with blockchain and distributed ledger technologies that expand the opportunity set for those investors as well. But those are some of the themes I think I could point to.
So is it like a natural evolution of the technology that, the macro internet-based companies, the ability to move data real time, settle real time with now stable coins and tokenized assets, it's a natural evolution of how maybe things started in the 90s with the internet?
Well, I mean, you say it started with the internet, but I mean, all of these activities started a long, long, long time ago.
Oh, sure.
Right? I mean, like one of the basic, laws, securities laws that govern a lot of these things, like our projects like Benji, our tokenized money fund, are called the 40 Act. They're called 40 Act funds because the law was written in 1940. And so, how we did things in 1940, where we were passing paper certificates around to each other, and you needed to self-custody, this particular asset by holding a piece of paper, and you had some sort of fire safe, or we started having these big custody businesses who were like, well, we'll take care of that for you so you don't have to worry about that. That is all just rapidly changing because of these technologies. And yes, it might have been the internet and the networking of, businesses and planets and entities all over planet Earth, but it's arrived at a pretty exciting time. In those 40 some years that I've described in my career, I've never seen more opportunities in asset management than I've, ever. So it's a pretty exciting time to be able to be in the space and exploring, quite frankly.
Roger, there are still some skeptics out there who said, who needs this blockchain stuff? Why does tokenization matter? So I'm curious if you can answer that question from a perspective of what Franklin Templeton's building. Is this a test? Is this an R&D project? Or is this something you are looking to build that's going to be the fabric of the business?
I think that's a really great question because a lot of times when technologies come forward and we start doing things, and we've been aggressive in exploring tokenization, and we have a big branded product that we're really kind of talking to clients all over the globe, and that's a tokenized money fund. Money funds are securities, and we still operate within the kind of geographic borders of various securities laws all over planet Earth. So we have a number of different Benjis. We have a U.S. Benji. We have a CCAV UCITS eligible Benji. We have a Singapore Benji. We have a number of those things. And we have been, and we have, over $1 billion of customer client assets in it. That doesn't feel like a proof of a concept, really. Right. But I think what we've really uncovered, because the question gets asked a lot, you used to call them skeptics, but it's really like, the current system seems to work. So what are we doing that's differently? Right. But what we have uncovered, and Benji, we just had this idea. I had this idea. Hey, how do we use distributed ledger technology in our business? I mean, ledger, that word ledger is really important. As I mentioned, the whole industry is full of records.
Yes.
Whether it's asset management, whether it's capital markets, records is what I'm honing in on. And this idea that this technology would be disruptive. Disruptive means it could, impact your current business. It could also create opportunities for you. Meant that we were just like, hey, let's start and do something. And now we started that some 8 years ago. So at that point, I think it was a proof of concept. But what we unpacked was being on these new rails created new utility. And that utility accrues to the users and the shareholders and the customers of the product. Now, in Benji's case, that utility kind of is in two forms. One, you and I can transfer Benji back and forth to one another literally as fast as a new block can be appended onto a blockchain. So those times are, fractions of a second. So I can move an interest-bearing asset back and forth between economic actors, individuals, companies, whatever, in less than in fractions of a second, number one. But because the blockchain is composable, we have been able to take the 24-hour cycle of interest, decompose that into seconds, and for however many seconds, minutes, or hours you hold Benji, I can pay you for those portions of the day rather than it's being on this 24-hour clock. Now that may, for you and I as individuals, I don't know if that's, super interesting, but for the billions and trillions of dollars that flow through the capital markets and financial system every day, an interest-bearing asset that if I hold it for 5 minutes, my asset is sweating, big thing. So big new type of markets that unfold because of the utilities of using these new blockchain rails in order to build products and services on top of. That's what we've discovered.
Pardon the interruption. Hi, I'm Tony. I'm the host of the Thinking Crypto podcast. I wanted to ask you if you can please support the podcast by hitting the like button, subscribing if you haven't as yet. You can leave a comment below as well. And if you're listening on a podcast platform such as Spotify, Apple, or wherever you get your podcasts, please be sure to follow and hit the 5-star rating. I'll let you get back to the content. Thank you so much.
Now, you mentioned there's a different form of Benji across the globe in the U.S. markets and different markets. Tell us a bit about, is that all connected to a central hub, so to speak, all running on the same blockchain rails, but just categorized in different regions?
Well, I think the way in our exploration of deploying these tokenization platforms, we started on one chain, but we quickly began to think about how, and when we started that process, by the way, again, we wanted to be a user of blockchain, right? We weren't sitting here looking back and saying, well, do cryptos X, Y, and Z have value? How do we extract value from those? It's like, these are new and interesting and vastly improved, data record systems. This idea that we both have the same copy of the ledger at any given time. Let's experiment and do things on those. And we found efficiency gains in the part of the securities business that we call transfer agency. So if we're in the business of issuing securities, we have rules and responsibilities wrapped around transfer agency to receive permission to issue those securities. And those are records that we have to maintain forever. Those are records of who you are, where you are, and those are kept in more private database systems that don't expose personal identifying information out into the marketplace. But it's the transaction records. So it is the things that say, hey, you subscribed, you redeemed, you reinvested in dividends. These transaction record keeping systems are large, and they grow, and we have to keep them forever. And so we were just kind of thinking maybe the blockchain would be a better place to house those records rather than in our centralized monolithic database system that we had inside of our transfer agency system. And so in that experimentation, we covered big efficiency gains, and that gave us super big confidence that this wasn't something that was just a fad, but these were going to be rails. These were going to be new infrastructure for the capital markets, asset management moving forward. And so we kind of put more chips on the table to develop what those outcomes would be.
You just mentioned something that these are going to be the rails for the capital markets. So is that where the puck is heading in, where banks, investment firms, stock exchanges, you name it, and would plugged into the government with the treasury and so forth, all of these things will be running on blockchain?
Yeah, I'm going to go back. You made a a statement that I was kind of raising eyebrows about. There's still skeptics. Still skeptics. Where are those skeptics? By and large, I mean, we interface with financial institutions all over planet Earth. We were early and aggressive. I mentioned we just started experimenting in blockchain. We began to understand that maybe there's a number of different blockchains that are going to be winners here. Blockchains are technologies. They'll continue to iterate. There's in the information-based economy, we think of these as just utility rails and pipes for the information-based economy. So we want to be on as many of those ecosystems as we can because that's where we're going to find customers eventually. And so it's not one winner takes all.
Right.
In our environment, we think of these as kind of digital nation states. They have their own economies. They're aggressive in pursuing and growing their own economies. We want to grow with their economies alongside of them, whatever we may decide to bring as a securities related product or service on top of those rails. And so that's kind of where our journey. So our journey actually permeates across a number of different blockchains. I think we may be on either 10 or 11 blockchains currently with our products and services. We are in the process of building a tokenization factory. And we are doing that and we're deploying toward that end specifically because we have massive confidence about all of these legacy partners that we know that we worked with in traditional financial service firms over time are going to be coming onto the Web3 wallet ecosystems. And of course, there's just hundreds and hundreds of millions of Web 3.0 digital wallets all over planet Earth already. And we want to be able to provide products and services into that existing ecosystem as well.
Now, you mentioned you're building on public chains and a handful of them. And it seems it's going to be a multi-chain world, as you alluded to. But are you also looking at building your own internal permission blockchain? It seems like that's a hybrid model is kind of what some people are doing, where they're bridging to public chains.
I think the short answer is no.
Okay.
I mean, and that is obviously a trend. We talked with friends yesterday. Coinbase has a blockchain.
Yes.
Right. And I was asking questions like, look, hey, in our past life, and when we're counseling and talking to, investors all over planet Earth, the previous kind of construct was, let me choose a custodian where I know my assets are safe and trust. And usually they have relationships with these entities over decades, quite frankly. Our institutional investor communities and clients have. And then let me work to find where I can get best execution, because in my fiduciary responsibilities for these clients, I have to make the lowest transaction cost. Where can I get the best execution on whatever the idea is that I'm offering advice on to them? But all of those are kind of subdivided, different actors. And now, you have somebody like Coinbase who's like, well, we're the exchange. You're going to custody with us. And it's our blockchain that you might be involved in too. So it's a real interesting conversation when you're describing this ecosystem to other institutional investors and adopters who are so used to being like, well, all of these things are separated out. How can they be all knitted together? And clearly we're seeing large cases where, people like Robinhood are saying, hey, we want our own chain.
Yeah.
I think that's a really interesting strategy. Franklin Templeton is not diving down to that strategy. Mm-hmm. We want to be part of a bunch of people's chains. Sure. Quite frankly, and ride inside of those kind of, like I said, digital nation states as they grow. Some of them will grow faster. Some of them may become obsolete. We don't know. But we do know that there's a lot of capital deployed by these legacy chains. And some of those actors like Ripple have really fantastic plans to be able to take that capital that has grown an XRP over time and be able to redeploy that to build, quite frankly, substantial businesses. And they have a lot of money to be able to deploy to make those ends come about.
Oh, absolutely. Now we're seeing different types of assets being put on the blockchain, money market funds. Obviously Franklin Templeton is doing that. Are you planning to do anything with other asset classes, precious metals, real estate, and things like that?
Well, yeah. I mean, I think what is unfolding in front of the opportunities, and this is why I'm saying it's so exciting, is that as we approach opportunities in what we call the have wallet ecosystem. So we're talking about the Binances and the Coinbases and OKX and Krakens, of the world that have literally hundreds of millions of wallets. Those are potentially new customers for us. our journey started with money funds, but with our 1.7 trillion, and we cover basically every asset class on the planet. How can we take those our services of offering advice around those things and bring them delivery into the new have wallet ecosystem? Simultaneous, you have all of these legacy actors who are just over the past year, quite frankly, have permissions to be able to seek wallets. Those are our legacy business partners for decades, quite frankly, and we know they're going to be coming in this space. And so we are firm believers that we will meet customers, large and small, in a Web 3.0 wallet service somewhere. And so, we're going to, over time, and it will take time, transmit all of these other things into this type of, you want to call them tokenized, but really what they are is just a new kind of form that clients are holding the asset, but they're still a security. They're still, they're wrapped in securities, or they're wrapped in a commodities type of wrapper. At least that's what our experience is showing so far.
You mentioned Binance. I read recently that you have formed a partnership with Binance. Tell us about that and how you'll be working together.
Well, Benji is, we are working with a number of different exchanges, and Binance is one of those, to bring specifically some of their institutional customers who want to trade on Binance but want to hold a yield-bearing asset as collateral inside of the trades versus a non-yield-bearing stablecoin. It's as simple as that. How do those customers, who are doing maybe complex derivative trades, get a little bit more economic value by holding something that sweats yield all the time? It's pretty simple in that construct. There's a number of different exchanges they're doing that. We've been doing that with OKX as well. And we're having conversations because what we have done specifically with Benji is that we have worked hard and persistent, invested a lot of time and money to work with the regulators so that Benji is actually natively on-chain. We're not a shadow record keeping. We're not a digital twin of any sort. We're actually native on-chain, and that gives a lot more permissions for these ecosystems that are absolutely on-chain as opposed to relying on the legacy transfer agency processes and systems. And so that makes Benji a perfect candidate to be brought into these kind of constructs.
You mentioned earlier sweating yield constantly. With the tokenization of assets, you now have 24/7 markets, 365, no more opening and closing bells, so to speak. How are you managing that? Are you using AI? You have global teams, that type of thing going on?
If I understand your question correctly, moving from basically what is a fund is a 5 business day a week into a 7, day business, 7 day, 24 hours a day environment is a gap. There's a bridge to get there in that construct. And so we're working with a number of different actors, liquidity providers. This idea that for the near term, while certain stablecoins have achieved this ability to offer rewards, depending on top of which platform that they're riding on top of, this idea that that a money fund which offers full transparency of whatever the collateral may be, and it by construct it kicks out all of its yield. We don't kind of have to determine what we're going to be paying out. It's all a function of the underlying collateral that we own, the assets that we own underneath it. What that means is we are in this phase right now where we are trying to find liquidity between stablecoins and money funds. That's a new thing, right? Stablecoins are relatively new, and there's obviously a lot of transaction activity in stablecoins. I think we could point, and you'd probably know this as better than anybody, the biggest killer app on all these blockchains. If you think about the number of records being, appended, if you think of a blockchain as an entity that, sells block space, the vast majority of block space that they sell is stablecoin moving from, party A to party B, by and large. And the idea that there's this other now new complementary and kind of similar, but the benefit of the yield component on it can come and begin to interoperate and collaborate, be a substitute for a number of word choices if you want to come up. The idea that there would be markets between tokenized money funds and stablecoins is something that we're aggressively pursuing. Now, the financial system is going to continue to lurch forward from 5 business days to 7 business days, and we're seeing that kind of begin to come about, but we're talking about a heavy lift on a whole bunch of things to get to that space. Whether you and I are both around and focused on these things, by the time that comes about, maybe have some uncertainty on that.
Are there any risks that, and I don't know how much you can share on this, from a risk mitigation standpoint, are there any risks when it comes to tokenized assets and stable coins, like maybe things that haven't been proven as yet, or we still need to test the waters because we don't have the full network or all players on board? Are there any risks that keep you up at night, so to speak?
I actually sleep pretty good at night, and we wouldn't be deployed with customer money if we didn't think that we have been able to mitigate any risks whatsoever. I think in general, if I've looked back over my 40 years of experience, we've obviously increased the velocity of activities. So harken back to the global financial crisis. Where were you in the global financial crisis?
Man, I didn't know anything about the financial markets. And Bitcoin was my financial university, so to speak, where I learned how money works, how the economy works, how the Fed works, and all that. So I was just an onlooker.
Well, as you were onlooking, you probably realized that weeks, months transpired as different financial institutions began to be woven into the kind of the damage that began to permeate through the financial system. It took months for and took collaboration by regulators and rescuers to come together, pushing company A into company B in order to stabilize the system and all that kind of stuff. Fast forward to a couple years ago when in one weekend, Silicon Valley Bank and First Republic went under, right? And so velocity of bad outcomes has definitely increased. And what we're talking about when we're talking about blockchains and these economies, we're talking about networking, right? It's a network economy. In the global financial crisis, one of the words we were all feared was contagion.
Yeah.
Where's the contagion?
Remember that.
And the word contagion implies that there's networking, something happened here, but it's linked somehow, network to something over here. And if this domino falls, that's going to tip over a domino over here. Well, think about that. Blockchain and the networking and the contagion impacts, something happens and it permeates across the system pretty quickly is a real live factor. And we started having conversations with the SEC about these things. It became clear, and to a wizened, grizzly old veteran myself, just because we can do something, should we be doing something? I mean, I remember being on a trading floor in the fall of 1987 when the stock market dropped by 25%. What was the response then? Well, let's put in circuit breakers. Let's stop the activity. Let's let, rationality return, or let's have the market participants evaluate the situation and come in and make a decision about where to go. When we get to 24/7 constant velocity, will we have those same circuit breakers? Will we have to implement those type of things? It's possible because these are what's happened in the past, by and large. The other thing that I just get a little bit concerned about is the fact that a lot of this ecosystem and digital assets and blockchain have developed post the global financial crisis.
Right.
Now, I say the global financial crisis, and what I really mean was a full-born credit cycle, right? So when we have companies going under, when we have more bankruptcies on individuals, what history shows when we have credit cycles is when the weakest links find themselves. Now, we could have had a credit cycle during the pandemic, but monetary policy authorities all over the planet flooded the planet with liquidity and prevented a full credit cycle from developing. So we developed this whole new ecosystem. It's about networking and possibilities of linking contagion in a more aggressive way. And we've done that without having any credit cycles. So, what happens when the credit cycle comes about? And, do we have enough kind of watchdogs and firepower on the other side to kind of help solve those problems as they come together? Again, I sleep well at night, but I have been in business long enough, and I've been a student of things long enough to know that it's really credit cycles that are going to cure any sort of, fallacies that exist, any sort of, failing points that might exist currently, they'll be exposed in that, and then it will right set the environment for another huge expansive wave of growth. But those would be my wisdom.
Sure.
You invite me here to share kind of years and decades of wisdom to you. Those would be the things that I would kind of share with you.
Oh, absolutely. And I ask those questions because I know I get them sometimes. I know the answer, but there are people who are new to this. Is all new to them. They're like, well, what are the pros and cons? What are the risks? And I think it's great to have someone with your expertise to be able to share, the knowledge around that and how some of these things can be mitigated or are being mitigated. And I'm curious, would AI be a big help in monitoring blockchains 24/7 in the markets? And is Franklin Templeton looking to leverage AI in that way?
Well, we looked at like all businesses, we're going to information-based business. We're looking to leverage AI in a number of different ways. If I was a regulator, I'd be having AI. The beauty of the public blockchains, and when we were actually beginning to talk with regulator friends, years and years ago now, and to seek these permissions, what we're doing, the idea that many of these blockchains are public blockchains, and with the right tool sets, you can surveil them, the activity. If I'm using these blockchains in my transfer agency process, you can kind of surveil that transfer agency process. You're not going to know names of people, again, because we will never expose customers and clients' names in any sort of public place. We protect that. But the idea that, the movement, the transactions that are happening, you can do that. I mean, previously, if some regulator thought there was bad acting going on, they would go to judge, they get a subpoena, they come into you and they say, okay, we're going to come in, we're going to look at all those records. But like literally now you can surveil and observe them with the right tool sets. So, I think because of the public nature and the massive amount of information that's available on these public blockchains, of course, AI are the tools that it's used to be able to understand all that in a pretty efficient way.
So Roger, it is 2035. What does the tokenization market look like? What does the markets look like? Is it all, like you mentioned earlier, running on blockchain rails, the convergence of crypto and TradFi, and there's just one market?
Okay, so this is 2026, and you said 2035, so 9 years from now. Look, I think actually we're not going to be talking about tokenization well before then, because I think like lots of things, we use word choices as we transition from one thing to another. The user experience will just know, I have a record somewhere. I have an asset somewhere. It's held here in this wallet somewhere. Is it called tokenization? Is it called blockchain? I don't really give a crap. Quite frankly, I just know that it's there, it's protected, and it's there for my use and for, to grow my assets and portfolios. I think in 2035, what we're likely to see is blockchain to be able to allow a whole new array and different types of assets to flow. And this is where I actually kind of sunk my teeth in this whole thing many years ago. Yes, I was focusing on ledger, distributed ledger technology, but I also was aware and had spent a lot of time in my career trying to figure out how I could keep expanding the opportunity set of investments for clients. So, I had a friend at Franklin Templeton who went on to work at the biggest pension fund in the country in Sacramento for a period of time. And then he came back to Franklin Templeton, and he was describing to me one time about a project that they had done at this super large pension fund in Sacramento. And the study that they'd done had said that if you examine all of the assets on planet Earth, again, this super large public pension plan in Sacramento had... they see every investment opportunity possible. They have every manager coming in and saying, what about this? What about that? So they see all investment opportunities. But in this study that they had commissioned, they had come to determine that they really only touch about half of the planet's assets. And this was only about 10 years ago. That's pretty interesting, right? You see every investment opportunity, but you're only seeing half, quite frankly. So is there a possibility that these blockchain technologies create more fungibility for maybe that remaining half of assets, whatever the case may be? And so can we raise the efficient frontier? Will we raise the efficient frontier, that, that curve that we draw a tangent to say, this is the mix of assets that I want that gives me the best risk-adjusted returns over time? Or maybe we do away with the idea that we don't live in a two-dimensional world of risk and return. People want other things from their portfolios. They want outcomes. They want impact. So maybe there's third or fourth vertices, quite frankly, in dimensions. And so now we're optimizing clients' portfolios across a plane rather than across a curve and a tangent to that curve. I think that's what we're going to end up unpacking. I think we're going to end up having more and different type of assets. I think for individuals, those assets will have emotional appeal. And when they have emotional appeal, they're sticky. And if you're an advisor and you're offering advice to customers and clients and you're drawing in things that aren't just financial assets, but they're in investments and other things that have an emotional appeal, you have a better chance of counseling and keeping that client for a long period of time. So this is, all of these things is what I speak to about why it's such an exciting time, because of these technologies allow you to be able to focus more intently on customers and what they want. And when you can deliver, we know from any business, if you can deliver to customers what they want, then you're going to have a customer for a long time.
Absolutely. The emotional connection you're talking about, are you highlighting, like, let's say rare artwork or certain collectibles, even like, look, a Pokemon card just recently sold for 16 point something million dollars, right? Yeah. It's a piece of cardboard. Obviously, there's a rarity to it, but like, could that be tokenized?
Well, yeah, certainly. There's a lot of people who have cultural assets, and we're engaged in a lot of different projects. And you probably have talked to my friend Sandy Call about cultural assets in the past. And so we have some proof of concepts we're exploring. We have a lot of partners who are thinking about that. The idea that you might be tokenizing interest in sports clubs, for example, and bring that.
Sure.
So yes, those could be some of them, but there's a lot of other things. I may be a little bit too far afield in talking about this, but when I talk to my kids about what the best investments are, they're investments in experiences in my book. You can have a good pile of money and you might be able to have more experiences. That's true. But it's this idea that there's more to investment than just financial returns lots of times. And so, this is all, changing and unfolding in front of us. And so, if you're focused on those opportunities and you're doing some R&D activity, I think that's what we found ourselves doing. It's just like we had support to do just basic R&D activity in distributed ledger technology. And it's now unfolded this whole, interesting world of the things that I'm talking to you about. That feels pretty good, even having spent, almost 40 years in the industry.
Oh, yeah. I'll give an example. We're in New York. I'm a New York Knicks fan. I'm a big basketball fan. If the New York Knicks tokenize themselves, I'm buying. Yeah. Even if I don't get a return. But if that token allows me to earn certain rewards or benefits or perks, I could go meet one of the players, go on the court at some point, depending on how much tokens I hold.
So that's exactly what you're saying. Yeah. What you're doing is you may be investing in that, and it might not be a cash flowing investment, right? You might need to be awaiting, new media deals that cause the enterprise value to rise over time. But if the New York Knicks are going to give you more experiences from that, that fills your need, right? Especially if that experience comes in a championship year, for crying out loud.
Right. Yeah, that would be amazing. So it takes like
New York Knicks winning a championship would be amazing. Agree. Yes. Hope we see it again in our in the next several years.
Yeah. Well, hopefully this year we're hoping we can.
Bring it closer. Right.
But no, to your point, it goes beyond just a monetary value or even a return. Just creating these experiences. And could you see big companies like an Amazon and some of these retailers doing things like that, maybe with stable coins, but also tokenizing themselves in different ways, and it builds more customer loyalty, brand affinity, and things like that?
Yeah, for sure. We see the ability for enterprises. Loyalty programs have existed in airlines for a long time, right? And in fact, I think it's a fact that the loyalty programs for the airlines are worth more than the airlines themselves. Now, airlines have this business model where they lease, the airplanes, so the airplanes are really owned by somebody else. But the idea that there's this big sticky, I'm flying United home tomorrow, and my wife won't book me on another flight besides United flight, anytime soon for a long period of time. They take that model and apply as their creativity apply to bring that to other type of industries. For sure, we see those possibilities unfolding as well.
I remember Sandy Call, and I read some things about Franklin Templeton building crypto wallets. What can you tell us there? Are you building more for the institutions, for retail, and things like that?
Well, really, it's kind of funny. We had to get permissions to use blockchain and the transfer agency activity for Benji, and working with the regulators, I mean, that has to be held in a, what's it going to be held in? You're going to create a token, what's going to go in? It's going to go in a digital wallet. So that's exactly what we've done. And we build those digital wallets across, a number of different blockchains. Those digital wallets, we're in our building of that. We see a world of interoperability of blockchains, and we have to be able to, we talk to the regulators, in the very, very, very remote chance that blockchain A goes down, all of our customer experience has to be on blockchain B immediately. So, I mean, I think you can think of us as had problem solved some interoperability issues already. But this idea that we have built digital wallet ecosystems wrapped around a number of blockchains and in a securities permission space, right? Because there's a lot of digital wallets on planet Earth. I have 2 phones in my pocket over there. That means I have 2 digital wallets on my Apple phones, right? Now those aren't wallets that hold securities, by and large, right? I mean, again, my United ticket tomorrow is held in one of those digital wallets. But this idea that Web 3.0 digital wallets, where you and I can control ourselves, and where we can actually, we get the outcome of what's in the wallet, as opposed to somebody like Apple just taking that information and using it for their own benefit to provide us goods and services. Right. Those are the futures that we see. And we've had to be, and we've developed digital Web 3.0 wallets, and we have a lot of inquiry and discussions with folks who don't want to go through the brain damage that they've gone through. To is there a way that we can leverage Franklin Templeton's digital wallet ecosystem? I have nothing really to report about that specifically, other than that, yes, we have built digital wallets across a number of different blockchains with our kind of proof of concept and yet commercially viable and expanding Benji array of assets. We expect to have, digital representation, tokenized representation of a wide variety of our products and services in the future. They'll have to be held in a wallet, whether they're in our wallet or whether they interoperate with somebody else's wallet. We're an advice business, not necessarily the infrastructure business, but we see the future needing to be in the wallets.
Yes,
for sure.
Yeah. So going back to that 2035 question again, our majority of us with our phones, our digital identity, our assets in a digital format, tokenized, stablecoins, things like that, crypto assets, all in a unique central wallet, or are we having multiple wallets, you think?
Well, I don't know. What do you think about, you're still going to have a phone?
Yeah, that's a good question.
Are you going to be using those? Are you going to be using those meta glasses? Are you just going to talk to it and something else happens? I don't know what the hardware device is of in the future, but yeah, the idea that you can control, that's the problem. That's the kind of thought about Web 3.0 and different between earlier versions of the internet, where you can control the outcome, where you're an owner of the assets and you can permiss others to access your data and your information. We see that world, unfolding in front of us. So yeah, lots of opportunity.
Oh, for sure. Now, Franklin Templeton has a big ETF business, and you've launched a lot of different crypto ETF assets, ETFs. I'm curious, what's your strategy there? Do you foresee tokenized assets living in ETFs as well?
Okay, so let me unpack that question a little bit. Okay. I think the ETF, the bringing crypto into the securities form through the ETF and unlocking the opportunities in the legacy wallet broker dealer was a big watershed moment. Because previously you had more do-it-yourself, individual investors with all these digital wallets who were buying, Bitcoin and ETH and Sol and a variety of digital assets, including NFTs like Bored Apes and all that kind of stuff inside of that digital wallet. And now all of a sudden, the first time you had, I don't have to have a digital wallet. I already have a relationship. I already have a broker dealer account for crying out loud. I probably have 4 or 5 of them. And now I can buy this exposure to this emerging thematic story about the expanding blockchain and the importance of being able to invest in networks into my own broker dealer. And you can do it at a really low cost. We have a passive market product that we call Easy Peasy.
Easy peasy.
So we're making crypto easy peasy, make investing in crypto easy peasy. It's kind of a nice little jingle to say. But I mean, we're offering that at like 19 basis points for crying out loud. So I mean, culling out a lot of cost to allow that to happen. I think that was a big watershed moment, because a lot of investors had either had to be, I got to do this and figure it out myself, or institutional investors would be paying, private funds with private fund fees a lot of money to make that happen. So I think there's going to be a lot of change because of the ETFs themselves. Now, the second part of your question was, remind me.
If tokenized assets will be in ETFs as well.
If tokenized assets are ETFs. I think of ETF, an ETF looks like a stock, right? But it's like a portfolio wrapped in a kind of a stock wrapper in some way, shape, or forms. There's, again, a lot of change that's going to come about because even ETFs themselves have a number of different components of the make the ETF work that are in this. Back up our conversation, whatever 30 minutes when I say there's rent seekers inside of the process that make an ETF work. Whether this technology supplants, replaces some of those is an interesting thought process. It wouldn't surprise me that it doesn't dramatically change in some way, shape ETFs. ETFs are the most successful, product on the planet, bringing money, and this is, and we do have a great ETF business, and we're focused on expanding our ETF business as it currently exists. But we're also smart enough and aware enough to know that there are technologies that come along in every industry that supplant whatever the current form is, whether that's albums and CDs and then MP3s, type of stuff. It's like all of that gets impacted in some way, shape, or form. So our eyes are always forward about how to make sure that we're prepared to deliver those services as the technologies allow us to do so.
Yeah, for sure. Roger, one of the things everyone is waiting for is the Clarity Act to pass. So I'm curious, what are your thoughts? Do you expect that to pass this year? I know that's a tough question, but also what would that mean for Franklin Templeton's digital asset business?
Yeah, I don't, market structure acts are certainly important. I think we're supportive of a number of different things as it relates to the Clarity Act. The defined rules always help all of us in the environment moving forward. We think things that are securities and act like securities and smell like securities probably should be considered securities. At the same time, we understand, again, these technologies have come together, and some of these laws, are literally 85 years old. Now, they're laws because they are protecting consumers. Right, by and large, I think that's a great idea. Quite frankly, we're going to see time and time again new things come about, and if consumers get abused in some way, shape, or form, that is not our desired outcome. We're in the business of trust. Right. We're in the business of trust. Everything we build and do has to be around promoting and expanding that trust. We even refer to our blockchain engineering not as software, but as trustware. And so that business of trust is and that brand of trust is hugely, hugely important to us. Any sort of, new laws that are coming about need to keep emphasizing consumer protections and promoting trust in the overall ecosystem, however it comes forward, as opposed to, displacing that trust and losing the confidence. I think that's what makes our capital markets in the U.S., some of them robust on planet Earth, and the great promise of that you can accomplish lots of things. There's lots of different markets that have developed in the U.S. that haven't developed in other parts of the world because we have that robust ecosystem. So any of the type of new laws that wrap around these things, we do have to recognize that there are new things, though. The idea that you can invest in a network is a new thing, right? And so we don't want to constrict that behavior. We want to just modify it toward the benefit for all users. I didn't answer your question, did I?
Did the bill what do you think the bill is going to get passed?
Don't know. I don't really have a good idea on that. I do believe that, some of the large sponsors of the bills are now contending with a new environment with crypto winter. And so it's been really important. I'm sure they will be doubling down their efforts to try to move it through. But, politics is not something that's really easy to predict or hedge.
Well, the big battle that's kind of holding up the bill is the banks pushing back on stablecoin yield, which was part of the Genius Act. Any thoughts on that? And the banks may be trying to still hold on to interest and yield in that way.
Well, you say banks, money funds. That's a differential between Benji and a stablecoin, right? And so the idea that again, if you pay rewards, you get a tax document that says you're getting some sort of reward. Is that interest? Is that a reward? What does that come in? The idea that you hold an asset, You're going to get some reward for holding that asset. That reward has an economic value. Does that look and act like a security, or are we trying to make big carve-outs? Look, we know there's a geopolitical strategy for the U.S. to be able to expand U.S. dollar stablecoins deeper across planet Earth, for the retain U.S. dollar as the currency of reserve across the planet. And so there's a lot of momentum in Washington, not just by the crypto or digital asset community, but anything that keeps the U.S. dollar in that position is going to be massively supported by and large. I think that's the big thematic reason to pay attention to this fight over about whether a stablecoin can offer yield and whether that imperils community banks that sit in every corner, on Main Street in every town by and large. And they may not have the name J.P. Morgan Chase on them, but they might have your state bank type of situation. Those are real things, right? I think what you want to be careful about, going back to the global financial crisis, what did we learn? We learned from the global financial crisis that if the banks aren't operating, the economy doesn't operate.
Yeah.
Right? And if you're going to be doing things that remove a tremendous amount of the revenue and or profit potential for banks themselves, a stable coin doesn't, when you put money into a stable coin, there isn't a multiplier effect that they lend it out into the economy and fund mortgages or fund small businesses in any way, shape, or form. They take it, they earn the yield on the T-bills, and they pocket and put it in their shareholders. So there is, we found in the global financial crisis that banks, they're utilities. They're important utilities, and we need them to function properly in order for us to have a vibrant economy. This is, again, the difference between the U.S. economy and a whole bunch of other economies on planet Earth that have very fragile and unstable, financial systems. I did a lot of work in Argentina many, many years ago, and South America. And my visits would be, one day in Argentina and like 2 or 3 days in Montevideo, Uruguay. No, why is that the case? Argentina is a big country. Uruguay is a big country. It's got a lot of people. It's got a lot of cows. Love both countries, by the way. Just difference between the population base. Why is that the case? I'm in Montevideo, Uruguay. I'm there because the Argentines learned a long time ago that if your money's in the banking system, it's possible that the government's going to come in and take your savings account and convert it into long-term Argentine bonds. And so the confidence in the financial system themselves that eroded, so they wanted to move money out of the country.
Yeah.
We don't want those things outcomes in the U.S. And so there's going to be a dynamic at play here because of the way banks do. I think it's naive to think that banks just come in and charge interest. And so therefore, if we have a new form of money, we should be able to pay interest as well. And we're going to have the same operate in the same economy and helping expand the economy as banks have done for literally decades. That's probably a somewhat naive position, to be honest with you.
Yeah, I don't know what the compromise is going to be. We're going to have to wait and see. I think there was another meeting this morning at the White House between the bank and the crypto industry. So hopefully they find some sort of compromise and we can get the Clarity Act pushed through.
Yeah, again, I think one of the big, going back to early last year when one of the first moves by the administration was to kind of do away with SAB 121, which was the accounting, recommendation that said you had to hold $1 of capital for everything that might be in some sort of blockchain product or service. That was just a freeze ray on everything. And so we do want to unleash the creativity and opportunities that exist within the financial systems, here in the U.S. I think that's a noble and good idea by and large. How the crypto industry lobbies against bank, we do know also that there's a lot of money deployed by the crypto industry in super PACs prepared for the midterm election relative to what the legacy financial community is doing as well. So yeah, it will be super interesting to see who comes out on the right side of that.
Yeah, I didn't have this in my bingo card. The banks would, be battling crypto this year on that. But hopefully they find a balance, right? I think that's important. But to your point, I don't think you can just, with all the things that banks are responsible for, like you mentioned, mortgages and all that and credit and all that, we can't just pull the seat from under them.
The other thing that's going to be important, and we saw this in the global financial crisis too, it's the lines kind of credit. Also, ultimately, whether it's in the banks or it's in stable coins, it all sits inside of, this U.S. dollar that the Federal Reserve has responsibility for, and, the Treasury and all of that kind of system. And so we have to recognize that as well. And so it's likely if you have if you have some institution that has some sort of systemic risk associated with it, with a whole bunch of money from businesses and or, consumers, associated with it, then they are going to need to have lines, maybe even just like credit lines with the Fed as well. Put those type of things in place. Those are things that don't necessarily exist currently, right? I mean, we talked about that with money funds. Well, I mean, we'd love to have Benji be big enough that the Fed is like, we need to have you to have a credit line associated with that. Those are going to be important things as well, right? You don't want to grow up this thing by its own with, being permissionless and deregulated without understanding how it potentially gets woven in. Again, because while the Genius Act certainly for the U.S. Specific stablecoins defined what that collateral pool could be and should be and limited it, kind of in the same way that 2A7 money funds in the U.S. have a very limited types of assets that they can hold. That's just one step of that. When you think about that we haven't had a credit cycle unfold, let's make sure that we're making sure that we have all of the appropriate safeguards in place for all actors moving forward. So those are also going to be important things to be thinking about.
Yeah, well said. So Roger, what's on your digital asset roadmap for this year?
It's this idea that, now with, skepticism melting and more significant players coming into the entire using blockchain as infrastructure ecosystem, how we integrate with more of those, how we deliver more products and services besides just, kind of these boring things like money funds. Money funds are, I call them boring. We think of them as infrastructure as much as anything, not like really an asset class. But we kind of, helped kind of solve that problem and opportunity coming forward. So how do we get this experience of other assets into the both the existing kind of digital wallet ecosystem as well as kind of our legacy customers and clients who are exploring those? That's a lot of our heavy lift that we're involved in over the next couple of months. But it's an exciting thing to be doing, as I mentioned very early. Of the 40 years that I have been doing this, the idea that we're going to meet customers and clients in a new environment. We're going to be receiving assets, by the way, in these new environments, right? We know the projects by the Treasury, obviously NASDAQ, New York Stock Exchange. So the raw materials of asset management that are coming to us are becoming on these, blockchain rails. That changes a lot of the underpinnings of the operations that we have to think about. And then that third component I talked about, can we bring more and differentiated type of asset experiences into clients' portfolios? Those three things, that's a lot of wood to chop, quite frankly.
Yeah. Oh, absolutely. Well, I'm excited for the updates and I'll be paying attention. We'll love to have you back on as things progress. I have some wrap-up questions here for you. First, if you could create your own metaverse, what would the theme be?
Oh my God!
Where'd you put your Oculus and
metaverse? Well, I have some great passions in my life. I too like basketball. I grew up a Central Illinois boy, and basketball was everything we do. The movie Hoosiers could have been our community, by and large. So the metaverse would have a lot of basketball, and we're seeing this huge inflection point in women's basketball, by the way, right? The delta of popularity and opportunities in women's basketball is rapidly rising. That's super exciting to my family. I have a whole family of female basketball players. I took the Midwestern boy, put him in some alpine communities for a while. I love sliding down slick things at high rates of speed. Not as, at my age, maybe not as high rate of speed as I used to. My metaverse involves a lot of explorations and mountains and different type of topographies. I guess the other thing is I'm hoping in the not too distant future, as I get to experience, not just my own children, but another generation, about how to grandparent through that. I don't know. Is that really a metaverse? So I grandchildren, snow sports, and basketball.
Were you a Chicago Bulls fan?
The Chicago Bulls weren't very good when I was growing up.
Okay.
But my boyhood hero was a player by the name of Doug Collins, who ended up being a coach for the Chicago Bulls.
Yeah.
But he played at the Illinois State University, which is in Normal, Illinois, where I grew up. And of course, he went on to, I think he was the number 1 draft pick for the 76ers, and he had that experience in the Munich Olympics where, the U.S. did not win gold. We don't have to punch down through all that permeation of that. But Doug Collins was my childhood hero as a basketball player.
I loved him as a commentator as well. I enjoyed listening to him when he commented on games. Okay, rapid fire questions. Favorite food?
Favorite fruit? I like tacos.
Favorite musician or band?
Favorite musician or band? My favorite, if I said Taylor Swift, how would you feel about that?
Well, my daughter will love that.
Yeah, well, good. I'm appealing to your daughter. The women's committee at my house, I mean, maybe that's just happened because the women's committee dominates who gets to be on the airwaves at my house and on stuff. So I've taped into that. You know who else I like quite a bit is Green Day.
Oh, yeah.
Green Day is a Northern California
Love
band. They're East Bay band. I live in the East Bay. And so I love Green Day quite a bit. It was great to see them on a Super Bowl pregame show.
Yes.
Yeah.
Dookie, one of the best albums ever.
Absolutely, yeah.
Regarding Taylor Swift, every time I go into my car, my phone, because it's automatically synced with Spotify, Taylor Swift comes on.
Oh, yeah.
I don't like that, but my 8-year-old loves that.
Absolutely. So. Well, anything for the 8-year-old, right?
Yeah. Favorite movie?
Favorite movie? I love the Godfather movies.
Oh, yeah.
Yeah.
Those are great. Favorite book?
Favorite book? Wow. I love the John Irving novels. Quite frankly, the whole series of them. I spent 1 year of my academic life at the University of Iowa, and he was at the Writers' Workshop in Iowa, and I just liked his storytelling quite a bit. Turns out I think his grandchildren were Olympians on the alpine ski team in Italy, in Cortina right now.
Oh, wow.
So I read an article about that. But yeah, I always found his story is fascinating.
Wow, I'll check that out. When you're not working, what are you doing for fun?
Gosh, I try to keep myself, healthy and moving forward.
Sure.
Moving. I find that, I want to keep the body limber. I want to be able to, I expect to live to a ripe old age. I want to enjoy, multiple generations behind me. I want to be able to teach them to shoot a basket, teach them to, fish in a stream, teach them just to kind of enjoy life and I love spending time with my family, of course. I have very, very great long-term friends from when I was, even in first grade that are still really good friends of mine. And so
that's awesome.
I've taken up golf in the past several years. I used to think of golf as like kind of is it an old person type of game? I don't know. But I started experiencing golf with my wife and her family. And it was such an enriching experience. It was like, when I was a younger guy and I was playing golf, it was all about trash talking about, oh, crap shot. But what I really learned is it's a whole bunch of enriching. People might, my wife might totally full on break down laughing when I totally miss and swing a shot, whatever. But almost always there's something complimentary to say to somebody. Good ball strike or night direction. Oh, you're in the fairway. You only might be 30 yards forward in the fairway because you mishit it. But I found it to be an enriching thing, and it's a very humbling situation, right? And so you have to pace through life unlike that. Life is not. You have to be able to enjoy the journey through life. So you have to be able to enjoy the journey of the 9 or 18 holes, not just what the outcome is. I found that to be true in lots of life. It's not about the destination where you're getting to, but it's like the everyday journey that gets there. And I found that to be a nice humbling thing about golf that puts you out there. That you got to wipe away what just happened. And you got to try for something else. And every once in a while, a real miracle happens, and then you're hooked to keep doing it. But that's a new pastime for me.
I used to trash golf a lot, and then I've learned to respect it when I try to play with some people. This is hard, man.
Yeah.
To your point, patience, and it's a bit slow moving because I'm used to playing basketball and baseball, grew up playing those sports, but golf is tough.
Well, I hope you get to enjoy more golf. And what I also learned is if I golf, this is what I saw with my wife. She prioritized spending time with her father golfing, multiple times a month, and I wasn't at that time golfing with them. But I was like, if I take up golf, my kids will prioritize spending, and I invest in them. There's
Yeah.
going to be a time in my life where my kids actually prioritize spending time with me for 5 hours without phones or anything.
Yeah.
I'm in.
Yeah. Oh, yeah, for sure. I'll keep that in mind when my daughter gets a little bit older and I get older. But Roger, great conversation. Looking forward to the future updates around Franklin Templeton and digital assets. Thank you so much for taking the time.
Yeah, thanks for having me.
Thank you so much for tuning in. Please hit the like button, subscribe if you haven't as yet. If you're listening on a podcast platform such as Spotify or Apple, please follow and leave a 5-star rating. Thank you so much.